Gold has been remarkably resilient. We did see that bit of a decline when it looked like, well, when Trump was elected, President Trump was elected. It started, at the end of October, right before the election. So we saw a little bit of a decline. I honestly thought it was going to be a bit of a longer and deeper decline. But to me, it just shows that there is an awful lot of pent-up demand among central banks. I think it's going to mean the gold price is going to stay high. I mean, there's a lot of drivers, and tariffs are just one of them. Tariffs are just one of them. So I think the gold price is going to stay high. The demand is remarkable.
Gold has surged to another all-time high, with April futures soaring past $2,900 an ounce. Traders rush to position themselves ahead of decade's most significant financial realignment. Despite a strong U.S. dollar and the Federal Reserve maintaining high interest rates, gold continues its relentless climb. Meanwhile, President Trump has delayed tariffs on Mexico and Canada. Still, China remains a primary target, fueling market speculation about whether this is a tactical maneuver or the beginning of a more profound global trade and monetary policy shift. The key question now, is this a short-term gold rush, or are we witnessing the early stages of a prolonged bull market? Adrian Day, CEO of Adrian Day Asset Management, believes forces beyond traditional gold market dynamics drive this rally. Unlike previous cycles, where gold's movement was closely tied to the strength of the dollar, interest rate policies, or U.S. economic data, this time central banks are stockpiling gold at an unprecedented rate, regardless of macroeconomic conditions in the United States. According to the latest report from the World Gold Council, total gold demand, including over-the-counter investment, rose 1% year-over-year in Q4, reaching a new quarterly high and pushing the annual total to a record 4,974 metric tons. Central bank purchases remained relentless, exceeding 1,000 tons for the third consecutive year, with a sharp acceleration in Q4 to 333 tons. Investment demand surged 25% year-over-year to a four-year high of 1,180 tons, while gold ETFs saw a stabilization in holdings for the first time since 2020, marking a shift from the heavy outflows of recent years. However, Day notes that one significant source of demand remains absent: North American retail investors. So far, they have largely stayed on the sidelines, leaving a primary potential driver of future gold demand untapped. We're about to explore the video, but first, subscribe and hit the bell icon to keep up with our newest uploads. Your feedback in the comments is always appreciated.
Well, I think we all know that the main driver of gold for the last 2 years has been central banks in an effort to diversify away from dollars in their reserves in the face of dollar weaponization. So we all know that's been the driver. And of course, the central banks that have been buying gold, and as you mentioned, last year was another record high. December was very, very strong. So it seems to be accelerating, there's no pause. People were thinking there'd be a pause. But that has nothing to do with the strength of the dollar or the strength of the U.S. economy or whether interest rates are positive or negative on a real basis in the U.S. Or the jobs market or anything else. It has nothing to do with what's happening in the U.S. The sort of traditional drivers of gold, if you like, the macroeconomic drivers of gold, is not what's been driving gold this time. And it's not just central banks, of course. Beginning of last year, we saw a big spike in Chinese consumer buying of gold in the face of a declining economy or fears of a declining economy in China. Yuan depreciation, and of course concerns about the fragility of the banking system. So Chinese consumers moved into gold. But again, that has nothing to do with what I call the traditional macroeconomic drivers of gold. Gold has been remarkably resilient. We did see that bit of a decline when it looked like, well, when Trump was elected, President Trump was elected. It started, at the end of October, right before the election. So we saw a little bit of a decline. I honestly thought it was going to be a bit of a longer and deeper decline. But to me, it just shows that there is an awful lot of pent-up demand among central banks. I mentioned the Chinese, and also, of course, very wealthy individuals and families in the Middle East and in Asia in particular, but also in Europe, have been buying gold as protection against let's say, the fragility of the financial system. With record debt everywhere you look, both at the government level and in many countries at the household level, The debt levels among governments are frankly unsustainable. And so I think people are buying gold as a protection against that. You alluded to it at the beginning, and I think, we'll get to it, I'm sure. But the one source of demand that isn't there right now is what I'll call ordinary retail investing in North America. That's just not in the market right now.
The commodity market is set to keep investors on edge in 2025, with some commodities maintaining their upward momentum while others stabilize. A key factor shaping price movements will be the transition of power in the White House on January 20th, which will bring renewed focus to U.S. trade policy and its implications for China's response. According to the World Gold Council, global gold demand surged to nearly 5,000 metric tons in 2024. The ongoing U.S.-China trade tensions continue to drive investors toward gold, with rising inflation risks and rapid capital shifts further amplifying the trend. Adrian Day sees gold as offering the best risk-reward potential among commodities. While rare earth elements and uranium remain attractive, he believes gold's status as a safe haven asset uniquely positions it for sustained long-term gains. Now, let's redirect our attention to a video.
Gold is the one with the best risk-reward potential, because I can imagine a scenario in the next few years where I don't want to own copper and nickel, frankly, and that is if the Chinese economy goes downhill and the US and China get into some tariff war, and God forbid if they were to invade Taiwan. But I can imagine a scenario where other metals will not do well, base metals will not do well, but gold will continue to do well. So I would say gold has the best risk reward at the moment. But certainly other commodities, whether it's the rare earths, because as we know, it's not that the rare earths themselves come from China. As we know, it's all the refining is done in China. And so we need to move away from that. Copper is just very, very attractive to me. Uranium is attractive. So yeah, I mean, I think companies like Agnico with the rare earths, like Barrick with the copper, and Newmont now has copper, more copper than they did. Yeah, no, definitely. But those just add spice, if you like, or icing to the cake. Let's first of all say, if you or I were Chinese in the Politburo, would we be wanting to sit with the majority of our reserves in US dollar at this point in time? I don't think so. We would be wanting to move away from that as rapidly as we could. And that's what's happening. And I think that's just going to continue to happen, frankly. And I don't want to get political here, but when President Trump threatens the BRICS with 100% tariffs, what's the reaction of countries? What's the reaction of Brazil or South Africa or Indonesia, let alone China? Do they say, oh my gosh, Mr. President, we're so sorry, we didn't really mean it. Forget it. We'll sell all that gold and we'll buy the dollar. Of course not. It's the opposite. In my view, it makes them, they might give concessions to the US to try to stave off the inevitable, but they're going to want to move away from a dependence on the dollar just as rapidly as they can, in my view. To me, the price itself, and I'm not avoiding the question, the price itself is far less important than direction. And the direction to me over 6 months, 12 months, 24 months is definitely up. So who was it? Someone, I forget who, said, if you want to know what the gold price is going to do, tell me what the dollar's going to do. And gold is moving up in the face of a strong dollar. So when the dollar turns, if the dollar turns, then gold could move just dramatically higher in terms of US prices. I don't know. I wouldn't be surprised at all to see, we might get some backwards and forwards at the 3,000 level. We often do. But the way gold is moving right now, I think we could easily just break right through it. And remember, if most of your buyers are non-US people, right, they're looking at gold priced in Australian dollars or Chinese yuan or Japanese yen. They're looking at gold in their own currency terms. And so 3,000 is not a magic number for them. So I wouldn't be at all surprised to see 3,500 to 4,000, that kind of range, within the next 12 months.
For now, all attention remains on gold as it surpasses expectations, defying traditional market forces and hinting at a deeper long-term shift in global financial dynamics. Its record-breaking rally is not merely a reaction to recent economic headlines, but a reflection of growing global uncertainty, inflationary pressures, and structural changes in the financial system. As trade tensions escalate and central banks grapple with economic uncertainty, gold's status as a premier safe haven asset has never been more evident. Are investors underestimating the potential for gold to outperform traditional assets in the coming years? Join the conversation. Share your thoughts in the comments, give us a thumbs up if you found value in this video, and subscribe to stay engaged with our community.